And let's go ahead and do the closing. Now, what closing does is, closing, what it does is it updates the capital account and it prepares the temporary accounts, and I'll explain the temporary accounts for a minute. For the next accounting period. Okay? So here's what the procedure is. What happens on this is revenue, expense, and withdrawals. All of these are transferred to the capital account. So all of these are called temporary accounts. And the reason they're called temporary accounts is because they only temporarily have a balance. And then that balance is transferred to the capital account. So the capital account is updated, and this is what I mean by updated, at the end of the accounting period. Okay? And so the capital account will be increased by the revenue, decreased by the expense, decreased by the withdrawals. And the ending balance in the capital account of the ledger will now be the same as the ending balance in the statement of owner's equity. Okay? And another way of saying it, this does the same thing as the statement of owner's equity. This does to the ledgers and the journals to ledgers what the statement of owner equity does. Okay? It does the same thing. Now, so that's updating the capital. So these are all temporary accounts because they temporarily have a balance, right? And the permanent accounts, or I'll put it in the same format because it's easier to kind of put together. So assets, liability, and the capital account, those are called permanent accounts. And the reason they're called permanent accounts is because they don't empty out at the end of an accounting period. So like cash is an asset, right? So if you have $10,000 in your checking account at the end of the fiscal year, December 31st, how much do you have January 1st, beginning of the next fiscal year? $10,000. Okay? If your account's payable, a liability is $10,000 January or December 31st, how much is it January 1st? $10,000. Okay? And then the capital account, of course, is permanent. So these are permanent accounts, these are temporary accounts. Now, one way of looking at this is like the trip odometer in a car. Okay, this is like a trip odometer in a car. So what you do, you go on a trip, you put it at 0, and then you can tell how far you've gone. This is like the odometer. And in the odometer, all it does is it just keeps accumulating. Of course, now this thing goes up and down, it doesn't keep accumulating, but it just keeps, it has a permanent balance. So if you want to kind of a mnemonic to remember them by, these are like trip odometers. So we talked about how it updates the capital. How does it prepare the accounts for the next accounting period? Okay, well, here we have an income statement. Okay, and there's revenue minus expense equals net income. Right? Now, the only reason this works is because you have the revenue for this period compared to the expense for the same period, and that will give you the net income for that period. So that means they have to start out at 0, they accumulate through the period, you find the net income, and then you return them to 0 so they're ready for the next accounting period. And so that's what we mean by prepare for the next accounting period. And this is what we mean by update the capital account. Does that make sense? Okay. So this is what closing does. So, any questions so far? Doing good? So let's do this. Now, let me show you the mechanics of it. So I'll show you the mechanics and we'll practice it several times because much of this accounting really is just practice. It isn't necessarily that difficult. It's just practice. Is basically what it is. So let's do some practice in here. So let me show you what it looks like graphically, and then I'll show you what it looks like in journal form. So here we have an expense account. And let's just say this business has 1, just because it's easy to work with. And let's say it has a balance, let's say it'll have a debit balance, and let's say it's 6. Now this could be wages expense, could be utilities expense, we'll just call it expense, okay? And it has a revenue account. Now that could be service revenue, whatever. And of course it'll have a credit balance, right? Now, step 1 is you close the revenue to what's called income summary. Now let me make sure that this thing is still on the tape, and that way when you guys watch this at home it will make sense. So far so good. All right, let me do it this. Okay, all right, now so what we're going to do is we're going to, so that income summary account, here's what it is. Okay, and what we're going to do, we're going to transfer this to this. So the way we do that is we credit income summary, debit revenue, now revenue is reduced to 0, and this represents all of the income, right? And that's step 1. All right. Now, let's do this. It really works better. So let's take a look at Quick Study 4-9. You find that on page 159. And let's just do the first one. It'll ask you to close the revenue to income summary. So I'm going to put that up here on the board. We'll do step 1. So it's page 159. And it's Quick Study. You guys, how you doing there? You doing? You kind of settled in okay? All right. So let's do Quick Study 4-9. Here it is. All right, so here it is. So the ledger, and I'll put this up here. I'll take a minute and turn out that light so it's readable. Okay. All right. So here's what we're going to do. Is the ledger of the Argo company includes the following accounts. It's a normal balance. So it has a capital account of $6,000, L Argo withdrawals of $400, service revenue of $10,000, wages expense of $5,200, rent expense of $800. Prepare the necessary closing entries. So you want to do the first one. You want to close the revenue account to income summary. You turn it loose with that. Now, who needs to sign the vote? All right. Okay, let me do this. Here you go. All right. Here you go. All right, so here's what it should look like. So service revenue is debited for 10,000, income summary is credited for 10,000. Okay? So that's step one, you close the revenue to income summary. Now, let's kind of go back here to the board. And let's go take to the next step. So here what we have is now, so step one is you close the revenue to income summary. And here's what step one looks like. So step one is what you're going to do is you're going to debit the revenue account. And in this case, it'll be for 10. And you're going to credit income summary for 10. Does that sound pretty good? Now, step two, and I'll just write the number 2 here, is you're going to close the expense to income summary. All right, so how do you think we do that? Well, you're going to credit expense and debit income summary. So now you have a 0 balance, okay, and this is your total expense. Okay, now both of these are zeroed out, and so they're ready for the next accounting period. Okay? All right. Now, do you guys want to do step 2? And step 2 will ask you to close the expense accounts. Now, in this case, there'll be more than one expense account, so what you want is a compound entry here, right? Be sure you do a compound entry. So I'll turn out the lights. Turn that around, so be sure to do a compound entry when you do this. And again, what it says is now there's a wage expense, a rent expense, so both of those will be credited, and the total will be a debit to income summary. All right, okay, so this is working. And you're absolutely right, Kirsten. And the reason it's first is because it's the debit entry. So here's what it looks like. So here you credited both expense accounts. Now that'll zero them out because you'll have a credit entry equal to their debit balance, and the debit goes to income summary. Be sure it's a compound entry. You don't have income summary wage expense 5,200, wage expense 5,200, income summary 800. You don't have that. Wage and rent expense 800. Rather, it's a compound entry. And now these will be zeroed out, ready to go for the next accounting period, and they've been transferred to income summary. Sound good? All right. While you guys are taking notes, I'll move this camera. And then let's go on to the next step. Okay. So is everybody okay? Any questions on anything on that? Feel good? All right. Now, step 3 is we're going to close income summary to the capital. Okay, so here we have the capital account, and let's say it has a $20 balance. Here we have withdrawals, and that'll be the next step, DRAW, ALS. Okay, now we find the balance in here, and this balance is a $4 credit. What does this balance represent? Net income, right? Revenue minus expense equals net income. And now you close that to the capital account. So a credit is a debit, now it's reduced to 0. And if the debit goes here, the credit goes here, and so now your capital account was increased by the amount of the net income. So you close your income summary to the capital account. And that's step 3. Okay? By the way, let me put step 2 up here. Step 2 is income summary is debited. In this case, it'll be for 6. And in this case, we have one expense. This expense will be credited for 6. Okay? Now let's go on to step 3. In step 3, we're going to close the income summary to the capital account. So we find the balance and then transfer that balance. In this case, it's a net income. The net income will increase capital, right? And of course, the credits increase capital. Now, if it's a net loss, then you debit capital, right? And if it was a net loss, the debits over here would be larger because the expenses would be larger. But this is a net income. All right, you guys doing good? So let's go back here to this problem. Well, here's the fastest way to do this. Check this out. I'll go through here. Why did it take me this way? Okay. So let's go back to the board. So now what you want to do is you want to close the income summary to the capital account. So find the balance in the income summary and then make the transfer. And that, what you're doing is you're upping the income you're upping the capital account by the net income. Okay, so if we have a $10,000 credit income summary, a $6,000 debit, the balance will be a $4,000 credit. That'll be a net income. So we're going to increase the capital account by the amount of the net income and zero out the income summary account with the debit. And that's when it's a net profit or net income. right, you okay with that? So then, step 3 is you close income summary to capital. Here's step 3, the one we just did. Now in this case, it will be a debit to income summary to zero out its credit balance. Okay, and we're going to credit the capital to increase it by the amount of the net income. Okay? All right. Does that make sense? Okay. And then step 4 is we're going to close withdrawals to capital. So in this case, let's say the withdrawals had a debit of 1. So we zeroed it out with a credit. Now it's reduced to 0. If the credit goes here, the debit goes here. So the ending balance in your capital account will be 20 plus 4 minus 1. It will have increased to 23, and now it's updated. And so step 4 is you close the withdrawals to the capital. You guys want to go ahead and do that with the problem? And by the way, of the 3 classes that I've done this taping in, a number of people have really found it helpful, like when they had to miss a class, when they wanted to review. So I think it's worth doing because people have been finding it helpful, even though sure it's a pain. All right. So here you go. You're going to debit the capital by the amount of the withdrawal and credit the withdrawal. So there's a $400 withdrawal here. Right. So step 4 then is you debit capital by the amount of the withdrawals because you're going to decrease it. And in this case it's 1. And you're going to credit withdrawals to zero them out. To zero it out. And so now after all of this, your capital account is current. And this will be the same dollar amount as your statement of, as the ending capital in your statement of owner's equity. Okay? All right. So, step 1 is you close. Actually, well, by the way, step 1 and step 2 can be done in either order, right? And the book will change the order part of the way through. So, but let's just do it one way now, and then when the other way comes up, we do it. But these two can be done in either order. So in this case, the revenue is closed to the income summary. That's step 1. Step 2 is the expense is closed to income summary. Step 3 is the income summary is closed to capital. And then step 4, the withdrawals are closed to capital. And then the revenue and expense and withdrawals are all ready to go for the next accounting period. And your capital account has been updated. Okay? Now the only thing that I might add in this before we do our practice is close income summary to capital. So if that's a net income, if there's a net income, then what you'll do is you'll debit income summary and you'll credit the capital. If it's a net loss, then you'll do the opposite. What you'll do is you'll debit the capital to decrease it by the amount of the net loss, and you'll credit income summary to zero it out, because it'll have a debit balance. Does that sound about right? Okay, it'll be the opposite. So what we've been dealing with so far has all been net incomes. Now, are there any questions? Let's have a real quick review and then we'll practice. Well, let's have a quick review and practice. So what we're going to do here now is it's a closing entry. We want to update our capital account. We want to prepare our temporary accounts for the next accounting period. Revenue and expense withdrawals are temporary accounts, are like a tripodometer, and they're transferred to the capital account. Assets, liabilities, and capital are permanent accounts because they don't zero out. They're permanent, they don't zero out, they just keep accumulating. An income statement only works because you start out with the revenue and expenses at zero. They accumulate through the accounting period. You find the net income for that accounting period, then you return to zero for the next accounting period. It's a 4-step process. Step 1 is you close revenue to income summary. Step 2 is you close expense to income summary. That will give you the net income or net loss. You then transfer that net income or net loss, step 3, to the capital account. And then step 4 is you close the withdrawals to the capital account. Sound good? All right, let's do this then. And again, what we're going to do is we're going to practice this a few times. Let's do exercise 4-1. You find that on page 160. Let me put it on the board here. And so exercise 4, so 160. Here's 160. Here's exercise 4-1. All right, so what they ask you to do now is they want you to, okay, so exercise 4-1. So what they want you to do here is using the March 31st. Okay. So I'll turn this around. So using the March 31st, use March 31st as the end of the fiscal year. From the following ledger accounts, assume that all accounts have normal balances, prepare the closing journal entries, and post those to the appropriate accounts. So in this case, we have capital account is not closed. It remains the same. Now it'll be updated, but it doesn't close. Here's the withdrawals that close, here's the revenue, here's the expense, here's another expense, another expense, another expense, and here's your income summary account. Okay? So you want to journalize the entry on that? You just look different, never mind.
Oh.
Okay, and the deal is, you look different, and you look so different, I wanted to make sure, somebody from another class emailed me and wanted to come to this class, I wanted to make sure they got the role, but,
Okay.
and you just look different, because I tried to match your picture, okay. Now, let me check, who has the roll? All right, did everybody get the roll? Okay. All right, so here's the first one. You okay with that? I'll turn down some of the lights so that's more readable. So the step one is you close a revenue to income summary. Okay, so you're going to debit the revenue and credit income summary. Let me turn this out, it'll make it more readable. Okay, so here's the service revenue as a credit balance. So you debit service revenue, you credit income summary. Step two then is you close the expenses to income summary. So you're going to debit income summary for the total expense, and you're going to credit all the expense accounts. So, and be sure to do it this way. So you don't want 1, 2, 3, 4. You don't want 4 pairs of entries. You want one entry that's compound. Okay? So you're going to credit all the expenses, debit income summary for the total. So now, if we have a 74,000 credit to income summary, and we have a 52,100 debit to income summary, that means we have a $21,900 difference, and because the credits are larger than the debits, it will be a credit balance. That means our revenue exceeds our income, and you want to now update your capital account. And you do that by crediting your capital by the amount of the net income and debiting income summary equal to its credit balance to zero it out. Okay, so here's the $74,000 credit balance, 52,100 debit balance. Here's the difference. The credits exceed the debit, so it's a credit balance. And when you're done with that, the last step is you close the withdrawals to the capital account. And it looks like that. All right, are you guys doing okay on that? Okay. Okay, let's do one more. Let's do, take a look here. Let's do exercise 4.3. And you find that on page 161. So let me move this up to 161. Here's 4.3. Now what this does is the following adjusted trial balance contains the accounts and balances of the Showers Company as of December 31st, 2011. The end of this fiscal year. Compare the December 31st, 2011 closing entries for Showers Company. And then they do the post-closing trial balance. Now, here's step one. You close revenue to income summary. Here's step one. So here's your revenue account, 36,000. You close the income summary. Here's all your expenses. You got depreciation expense, equipment, salaries expense, insurance expense, rent and supplies. That's step two. And to be sure to make step two a compound entry with one income summary for the whole, all the expenses. Now here's step two, where you close the expenses to income summary. And don't forget, be sure it's a compound entry, so you have one income summary and all the expenses close to that one income summary. Now, 36,000 minus 28,100, that will give you the amount of the net income. And you transfer that net income to income from income summary to capital. And then the last step is you close withdrawal to capital. All right, are you guys doing okay with this? All right, so let's do this. Now, give me your attention. Let me, and Steve, here's that next step you asked about. So let's go start with this next step. Let me show you. Let's go back to 4.1. Now, when we post these closing entries to the ledger, notice what happens. The capital account now has been increased by the net income, decreased by the withdrawals. Here's the ending balance in your capital account. Withdrawals have been zeroed out. Service revenue has been zeroed out. Expenses have been zeroed out. This expense was zeroed out. Another expense zero, and your income summary has been returned to zero. So this is the total revenue. This is the total expense, and this is where you transfer the balance to the income summary. So here's the balance. So here's the revenue. Here's the expense, and here's the balance when you transfer the expense, and then you transfer that to the capital. Does that make sense? Then, let's check your accuracy. Then what you'll do is you'll do a post-closing trial balance. And so when you do a post-closing trial balance, the thing that's unique about it is it has no temporary accounts. Cash, of course, didn't change, it's still, the account's still there, supply still has a balance, equipment, etc. And the capital account has been updated, it's been increased by the net income, decreased by the withdrawals. So on the post-closing trial balance, there's no revenue, no expenses, and no withdrawal. That's the thing that's unique about it. Okay? All right, you guys doing good? So, let me kind of step through here. Now, let's take a minute here